In recent years, income shares such as infrastructure companies have been heavily impacted by higher interest rates. However, now that we are potentially entering a rate-cutting cycle, this could reverse, and we've been selectively adding to income shares which could benefit. One example is Cellnex, which is the largest owner of mobile tower infrastructure in Europe. After listing on the Spanish stock exchange in 2015, Cellnex grew quickly through acquisitions. Now, this created a lot of value, but also resulted in a lot of debt, which wasn't an issue when interest rates were zero or even negative in Europe. However, when interest rates rose rapidly, Cellnex came under pressure, as investors were concerned with the amount of debt they had, and higher interest rates reduced the value of infrastructure companies like Cellnex. Since then, the company has pivoted their strategy under a new management team. This has included reducing debt to more sustainable levels and prioritising organic growth over acquisitions. Now, looking ahead, we think Cellnex is nearing an inflection point in their strategy, where capital investment related to prior acquisitions falls off, resulting in a big improvement in free cash flow. This will allow Cellnex to start paying dividends from 2026, which we think could be rewarded. Interest rates could also shift from a big headwind to a potential tailwind. Firstly, Cellnex owns mobile towers, which are critical infrastructure assets. You can think of mobile towers as a landlord for telecom companies, where Cellnex rents space on their towers to telecom companies in exchange for long contracts. This provides Cellnex with defensive and predictable revenues. It also provides Cellnex with upside from long-term growth in data consumption, where in recent years we've seen significant growth in mobile data usage from new apps like Instagram, Facebook, TikTok, and we expect that to continue. Mobile towers could also benefit in the long term from infrastructure required to meet new technologies like wireless broadband or, in the future, artificial intelligence. Finally, we think investors are underappreciating the long-term earnings potential of Cellnex, with Cellnex trading at a discount compared to similar companies. We think this valuation gap could close over time as management delivers on their strategy or sells mobile towers at higher valuations. In summary, we like the defensive nature of Cellnex's mobile towers, with upside from growing demand for data and potentially lower interest rates. Key risks we are watching include lower investment in mobile networks, which could come from weakness in telecom companies, telecom company consolidation, or new technologies, as well as higher interest rates.